Hello and welcome back. Today we're going to look at trading and in particular costs and leverage that are related to trading. So on today's agenda we're going to look at some trading costs. We're going to look very little on arbitrage and how that can be related to trading costs. We're going to look a little bit at leverage, and in the end we're going to look at how funds can help us as investors when it comes to trading costs and leverage. So if we start here with a graph of a stock price movement during a day. Now this is simulated, but it could very well look like this. Then, for example, we might see that, okay, we have tops up here where we would like to sell. Sell. And we have dips here where we would like to purchase instead. So if we could do that, we see that we could make a profit here of the spread of $0.5 or 50 cents. So that would be very neat if that was possible. And we see that we have the same scenario down here, where we would like to buy when it's cheap and sell when it's expensive. Now it's of course not that simple. Usually if you have something like this, it would be that we have something called an ask price up here, and we'd have something called a bid price down here. So the reason they go up and down like this is not actually that we could buy at the bottom and sell at the top, but because there is always a spread, a so-called bid-ask spread, which means that if we want to buy, we have to pay the high price, and if we want to sell, we have to accept the low price. So unfortunately, we cannot profit on that. But let's assume that we could earn 50 cents on each trade by doing like this. Someone has to, right? Can we then still profit on it, or is it not possible? Usually, when you trade, there is a cost to each trade. And in Sweden, we usually use the word courtage, but in English it's called commission. So even if we could earn 50 cents per trade, maybe the commission we pay to the broker is too high, so we still cannot profit on it. So I took some examples from Swedish banks, and they express the commissions a little bit differently. So usually you have some minimum fee where you say that, okay, for every trade you have to pay at least, in Nordea's case, 59. Or maybe in the case of Avanza, you have to pay at least 7 crowns if you have a specific type of account. But often you also have something called a floating commission, which states, for example, for Handelsbanken, that you have to pay 0.09% per trade. So if you trade for $100,000, then you will pay 0.09% of that in a commission. And then they usually complement this with a minimum fee. So unless this floating commission goes up to 99, then they will take 99 instead. And then it depends on how big this commission is if we can actually profit on this arbitrage. Of course, there exist other players in the market which has lower commissions. Maybe they don't have to go through the banks. But at least for most of you and for me, we don't have access to that yet, at least. So we have to live with this costs of trading. And to take a little bit of an example, we can imagine that we invest 50,000 crowns in a stock which costs 100 SEK now. And then we sell it at the next trade and make a profit of 50 öre per share. Then we say that the commission maybe is 59 crowns per trade. Can we then profit, and if so, how much? So that's a question we could ask ourselves, what is the return? Okay, so we have an investment of 50,000, and we have a commission of 59 per trade. So we can start by finding out how many shares is it that we could purchase with this. Well, we have 50,000. Then each share costs 100 crowns, so we divide by 100. And that means we get 500 shares. Okay, then we sell each share at 100.5. So we take 500 shares and receive 100.5 for each, which is 50,250. And it means that we made a net profit of 250 crowns if we subtract the initial investment. However, we also incur costs from the commission, in this case of 59 SEK for the first and 59 for the other. which adds up to 118 SEK. And it means that our total profit would not be as high as we initially stated, but it would actually only be 250 minus 118, or 132 SEK. So as we can see, the initial profit that looked to be 250 is now substantially smaller due to this commission. So if we could trade with more money, then this fixed cost will not be so harmful. But at least for me, this is still quite a lot of money to have in an investment. So commissions do matter. And for me, this mainly means that I won't trade that often unless I can make some profit on it. But actually, I made a little bit of simplification. Just want to mention that. Because here I said that we could get 500 shares. The first commission of 59 we actually had to pay in the first trade, which means we should probably only get 499 shares here. But I just ignore that in this example. Okay, trading costs in StockTrack then. So you're going to use StockTrack in this course as a simulation for trading. And when you do, you should keep the commission in mind. So for example, we usually have a floating fee in StockTrack. And let's say that is 0.2% of a transaction. It means that every time you trade, 0.2% of that money that you invest or trade with is going to disappear in the commission. So if you make a lot of trades, you buy and sell, you buy and sell, you buy and sell, this will add up. So the commissions will keep taking from your money, and it means that you will earn less money than you would have if you just keep on with the stock. So being an active trader in the sense that you trade a lot might be costly. However, so more trading, higher transaction cost. However, you could lose money if you do not act. Let's say that you actually know that the stock is going to fall in price, or that you are certain of it at least. If you do not sell it just because of the trading cost, then you will lose value because it decreases in price. So being an active trader do mean that you take on higher transaction cost, but if you do it for a good reason, it's probably still worth it. So just keep the transaction cost in mind, but don't let that stop you from doing a good trade. It's always, not always worth it, but if it's worth it, you should do it. Okay, let's say that we can look at an arbitrage opportunity and cost. For example, we have Telia Sonera, which is traded both in the Swedish market and the Finnish market. And we see that the price of Telia Sonera in the Swedish market is 48.26 crown, while in the Finnish market it is 5.45 euro. Okay, and then maybe at the same time we have an exchange rate which we can convert kronor to euro with. All right, then we could compute the equivalent price in SEK of the Finnish market price of Telia. So we take this 5.45 euro, take it times 8.85, and we get a price of Telia Sonera of 48.23, whereas the Swedish market price was actually higher. So then you could think, all right, then we should buy at the Swedish market, at the Finnish market, and sell at the Swedish market because there is a price difference. This is what would look like an arbitrage opportunity. In this example, I've probably ignored both the bid-ask spread that I talked about earlier and also the commission that you pay when you do trade. So maybe the exchange rate is not exactly 8.85. Maybe the Finnish market price, if I want to buy, is not exactly 5.45. I don't know that. But probably this small price is not big enough to make an arbitrage opportunity because of these different types of costs. So the return of selling here, I computed, it's only 0.057%. It's not that big. And if we then had a fixed fee of, in StockTrack, like I said, 0.2%, we would lose money by acting on this arbitrage strategy. So when you get to the lecture on behavioral finance and why there might be some price discrepancies, you can keep this in mind, that trading cost is probably a reason for at least some of these differences. Okay, we now turn to something completely different, namely leverage. And although this is, of course, with an investor perspective, I will look at this as if this was a company, and I will explain why in a short while. So we're going to look at the same company here, which is worth $1 million US, or at least they're going to use $1 million US. Either we finance it with all equity, so we put in $1 million ourselves, or we finance it with 50% debt and 50% equity. And we're going to see what the difference is of different scenarios. So for example, let's say we start with investing 100% equity. So we put in $1 million, and we want to see how it went for our investment. Okay? We might get unlucky in this case and have a $500,000 loss. So it's quite substantial loss for this company. This will reduce the value of equity to only 0.5 million. The rest is gone in the loss. And that, of course, is quite bad for our returns. In this case, we actually have a return on equity of minus 50%, which is not very nice if you invest $1 million and then lose half of it. On the other hand, if we had leverage, so let's say I didn't have 1 million, I only had 500,000, but I still wanted to make this investment. In the previous case, I lost half of my money. If I now have only $0.5 million in equity, I incur a $500,000 loss, then all of my equity is gone. So in this case, if the last one was bad because I lost half of my money, in this case, I lost everything. I had a return on equity of minus 100% because I went into bankruptcy. So the more debt I have, the less loss I need to go into default and lose all the money I've invested. So why would you then take on leverage? Well, of course, if there's a downside, usually there is an upside. And also here, let's say that we instead have a $500,000 profit. So we gain money, the same amount as before. If we have all equity, we see that this will go up. We will have more value in the company. And in this case, we have a return on equity of 50%. And then if we do the same thing, having debt, now I will ignore any interest we pay on this debt. But more or less, it's going to be that all of this profit will end up in equity. So the equity will double from 500,000 to 1 million. And we make return on equity of 100%. So there's a much higher risk of a downside, or there's much bigger downside if things go bad. But if things go well, then leverage will help us gain money, or at least get a higher return on our investment. Okay, so how can we connect then this to an investor? Well, when you buy stocks, as you're probably going to do in StockTrack, you're going to be exposed to that firm's debt level. So we took the example of a firm earlier, and if you buy a stock, you're actually purchasing a part of a company. So if that company has a high debt level, then you are exposed to that financial risk. So even though we are not looking at companies now, we're looking at our own investment, we still might need to consider how big financial risk is the firm taking that we invest our money in. And also, maybe if we're investing in debt, like bonds, then it might make be even more important, because then the company can withstand less losses before they go into default, and maybe not even the bondholders get their money back. But you can also leverage yourself. It's possible to borrow money from, for example, the bank. And we come back to this when discussing CAL in a later video. But I already now want to mention that actually, when you do borrow money, you will have to pay interest on that money. So there's always a cost to leverage. You don't, I mean, if you have your money yourself and you borrow it from yourself, there's no one to pay interest to. If you lose the money, yeah, that's bad, but there's no cost that you know will come. If you borrow money from the bank, they will require some kind of return, and then you need to pay that also. And your investment then needs to be profitable enough to compensate for that cost. Okay, we talk quite a lot about funds in this course, and how can we relate trading costs and leverage to funds? Well, as I said, when I don't have that much money to invest, the trading cost, the fixed trading cost at least, can be quite high. And also, it means that I don't really want to take the small posts, because I don't want to buy a single share and pay 50 crowns in commission for that. So instead, I can invest into, if I take a 5,000 trade and have a 59 SEK commission, then it means that the commission is 1.18% of total investment. So before we can even break even, we need to have a return of at least 1.18%. Actually, it's slightly more, but almost like that. If we have a fund instead, then we have a lot of money who pool our money together into this fund, and the fund can then make the trade. And then they can, if each of these investors would buy 5,000 crowns in a single share, then the fund can take all of their money and do one single trade, and thereby reducing the transaction costs. So that's a good thing about funds for us. And it doesn't mean that the fund does not have to pay trading costs. They still incur that, and turnover is a measure of how much they are trading and how active they are. So the more turnover they have, the more transaction costs they should occur, even though it's lower for them than probably it would be for me as a single trader. You also might have management costs in a fund, which you don't have by yourself, although you could argue that spending time to find a good investment is a kind of cost, although we don't pay money for it. When it comes to leverage, I said that we can borrow money, but usually if I would go to the bank and say that I would like to borrow 5 million and don't have that much collateral, they probably won't give it to me. So I might be restricted, or if I'm not restricted, it's at least expensive. It's possible that the fund can raise money cheaper, and that way also reduce the cost and easier to leverage. And an example of a Swedish fund which has leverage is the so-called AP7 SOFA, or the pension fund which you get if you do not make a choice. They are actually leveraged, and I think they aim to have 50% leverage or so. So there is a fund who do use their economies of scale to leverage up the value or the investment in the hope that they get good times. Okay, so that's it for today. I hope it helps. See you next time.